everyone, and welcome to another episode of MUFG in Conversation, our series dedicated to exploring timely topics with key industry leaders in the innovation ecosystem. My name is Priya Rajan, and I'm the Managing Director responsible for National VC coverage at MUFG Tech Banking Group. Today, I'm super excited to welcome Steve, partner at Sapphire Ventures. Sapphire Ventures is leading enterprise VC firm with over 11 billion in assets under management. The firm partners with growth stage B2B software companies and early stage innovators, helping them scale from expansion to IPO through capital, strategic support, and of course, deep industry expertise. Steve is a partner at the firm where he's a member of the flagship fund investment team, and he's responsible for the most critical role of the firm's capital market activities. He's backed over 100 plus tech deals and serves on multiple boards, the names that you all know, across high growth companies. Excited to welcome Steve. And Steve, thank you so much for joining us.
Thank you, Priya, for having me. Appreciate it.
Of course, this has been in the works for so long, and I'm glad to have you today. Let's start with your journey. What led you to Sapphire Ventures, and how has your role evolved over time?
Sure. If you don't mind, I'll back up slightly before I talk about my journey and just give you a few more words on Sapphire and give you my take on Sapphire. Your introduction was great, but what I want to underscore are a couple things. We think of ourselves as a scaled specialist. You mentioned 11 billion under management, big number, but what really matters is that all of that is focused on B2B software. By being focused, we're able to be that much more value add to our companies, and we're able to do deeper diligence on behalf of our LPs. The other thing is we're coming up on our 15th anniversary as a firm, which is a milestone we're hugely proud of. So this idea of being a scaled specialist investor has definitely worked for us. As far as my entry into VC, it's really, there's really no one way to get into VC. People always ask for my advice on breaking into VC. And what I say is just, do what you do and do it well, and keep in touch with folks in VC. And one day, that may indeed happen. I started out at Stanford, and I worked as a consultant at Bain in the tech business, and then tried my hand at doing something entrepreneurial that didn't work out quite as well as I hoped. And one of my board members suggested that I could go to work as an investment banker, and this was right in the dot-com boom. And so 11 years later, I had become an accidental banker who really enjoyed and loved what I was doing, but was looking for another new change. And as it turns out, relationships matter, and what really carried the day, as it kind of always does, was personal and professional relationships I had with some of the founding partners at Sapphire, and ended up fortunate to be the 7th partner and the 17th employee at Sapphire back in 2013, I think it was. And today we have over 90 employees, almost 100, and still going strong. So as far as my role, I think that was one more thing you asked about, and then I'll hand you back the mic. But the thing that I'm most proud about in the role, like you said, is the capital markets aspect of what I do. It's both a investment team function and a company facing function. And personally, I think any venture fund that has more than about, 3, 4, 5 billion under AUM really should have this dedicated role. On the investment side, I'm providing hopefully critical inputs to the underwriting equations for the companies, right? Trying to understand how these companies might trade 5, 7 years later from a multiple standpoint. I'm also essentially running our secondaries desk. We like to double down on some of our winners by buying stock in the secondary market. And so I source and negotiate those transactions. But even more importantly, in a way, is I work with we have about 80 portfolio companies across our 6 funds that are in existence today. And I work very closely with those CEOs and CFOs on IPO strategy, M&A strategy, how to raise more venture debt, how to think about the next round, make strong introductions to MUFG for them so that they can get non-dilutive capital to grow. and just generally offer, the kind of capital markets advice that, comes from having been in the business for over 20 years now.
Can you walk us through kind of the firm's investment thesis? You did touch upon kind of where stage you operate, but kind of double clicking more on kind of the types of companies, stages, and the themes, more importantly, the themes that is interesting for you today, and how has that evolved with kind of the AI native models and the shifts that's happening at the enterprise software sector?
Absolutely. Well, as always, Sapphire seeks to lead investments, and typically we lead investments in Series B, C, and D rounds in enterprise software companies. Of course, in this market, that includes AI companies. I'm sure we'll talk a lot more about artificial intelligence and all of its ramifications. But we try to invest in companies that are aspiring to be global category leaders, typically in the US, Canada, Western Europe, Israel, in markets where these startups are trying to sell to the global 2000 or the global 5000 types of companies. For us, we call these companies of consequence, meaning that we're looking to back companies that even if we only invest when they have 10 or 15 million of ARR, they aspire to have over 100 million of ARR. They aspire to have billion-dollar plus valuations. They aspire to go public. They're not aspiring to be a local champion or a small M&A outcome, even if that can return LP capital. We focus on, trying to have the big outcomes. And then, it's generally worked. Hopefully the strategy, continues to work. But when we think about the strategy, we can't be more excited about software, because as people have famously said, software is eating the world, and it's just such a good market. We don't know why we would do anything else, right? Software cuts across every aspect of global GDP. Software has high recurring revenues, it has low capital intensity, high margins, high growth, and it's fueled right now by the emergence of not only the cloud, but AI. My partners and I couldn't be more excited than we've ever been to invest in software today.
I love that framing, the companies of consequence. It really speaks to kind of the fund's ambition and the kind of the scale that you're aiming for when you're investing. You work closely with the founders on IPO readiness and kind of the positioning around it. What are the most common challenges that SaaS companies face when preparing for kind of going public today?
Thanks for asking that. The first thing I like to say about IPOs when people ask is that, it's, first of all, I think the concept of an IPO window is a little bit of a misnomer. A great company can always go public, but because companies can choose their timing, a great company probably won't choose to go public in the middle of a downturn or in the middle of a lot of volatility in the markets. And so IPO windows are never truly wide open or slammed shut. They're just, it's just a gradient. And we really had a very robust IPO market back in 20 and 21. And multiples have compressed dramatically since then, as you know, in the software market. And as a result, a lot of companies that thought they would probably go public in 22 or 23, because they're applying, a much lower multiple to their revenues, have to wait a couple more years. But we're finally seeing the emergence of a cohort of, there must be 50 companies that we could count that have more than 200 million of ARR in the private venture-backed software world. And so that backlog of companies is going to start going public. You saw that with Figma in July, and you're seeing that now with companies like Klarna, and one of our portfolio companies, Netscope, which is on the road to go public right now. I think when we advise companies, it's less about scale, although scale is important for an IPO. We tell them the most important thing for an IPO is to be 100% bulletproof in terms of being public ready. The worst thing you can do as a public company is miss your quarter, or maybe that's the second worst thing you can do. The worst thing you can do is miss your first quarter. So basically, when you're a public company, you have to be prepared to be consistently delivering what you said you're going to do. And so we look at our companies and say, have they hit their quarter the last 3 or 4 quarters before the IPO? Now they're probably ready, especially if we can diligence that they'll be ready to hit their quarters for the next 3 or 4 quarters post IPO.
I think that's the beat and raise motion, right? And the importance of predictability in an unpredictable environment, of course. It's such a nuanced point and it's coming up more and more. How do you help founders build that muscle?
Yeah, well, I mean, for the IPO, we have some playbooks where, like Monday.com, for example, one of our successful portfolio companies, I met with the CEO and the CFO about 24 months before their slated IPO, kind of gave them a TikTok of a timeline of like what things you need to be doing between now and the IPO to be ready. We made the right introductions to the right bankers, to the right advisors, to the right, folks for their systems and records. I mean, there's a lot more to going public than just the IPO roadshow. There's a lot of work that goes into that. So we definitely help the companies with that. And one of the things that I would say right now in today's market that any company that's going public has to think about, the first question out of any public investor's mouth is going to be, what is your AI story? And even more directly, is AI a tailwind or is AI a headwind for you? And so you absolutely have to be prepared to answer that in both, marketing way on an IPO roadshow, but fundamentally to your business. You need to incorporate AI to make it a tailwind, not a headwind to your business.
100%. The public market, SaaS growth has continued to decline. I mean, I think in 2021, it was around 31%, and now it's sitting around 12%. What do you think is driving this deceleration?
Well, I mean, is it a little bit of circular to say the end of the ZIRP era is driving that, right? We had free money for many years, and as a result, companies were able to invest essentially unlimited amounts with very low dilution into growth. So people got a little bit careless in terms of, the economics of their business models. Any growth was good growth. I think at Sapphire, we focus on sound, solid unit economics, sustainable growth. And so we rather see, sustainable, profitable growth with good, gross and net retention metrics and things like that than hyper growth that's going to be, fueled only by continuing pouring equity into the engine, the inefficient growth engine of the company. So from my sense, I think that's part of the deceleration, is that the equity dried up for some of these companies. The other thing was that because companies across the board were cutting costs and tightening belts, especially things like go-to-market software, HR software, things that are seat dependent or things that are market growth dependent, have suffered over the last few years. But keep in mind, though, that this is the public markets that are only growing 12, 13, 14% now. The private markets that we invest in and some of the hottest AI companies, I think I have this metric correctly, in our Fund 6, the one we're investing now, of those 25 companies, the average growth rate at entry was approximately 150%. So more than doubling at some level of scale. So, it's not all bad news in the software industry. It just turns out that there's a fair number of subscale, low growth companies that are public, if you will.
That's right. And, I think exact opposite of it is we are talking about the reacceleration. I think you guys do an incredible report. The mid-year update shows, I think the 2025, the SaaS growth outperforming kind of the seasonal norms. And what do you think are driving some of those change? And do you expect that trend to continue going into 2026?
Yeah, for sure. Thank you for commenting on the report. Yeah, it's kind of a labor of love. Every year in January, we put out an annual State of the SaaS Capital Markets report, which, we try to get to the real data-driven answers, not just the, sort of the headlines. and I know you read it, and hopefully many others. We also make some predictions. We'll talk about that probably later. You'll probably grill me on some of those, but we do a mid-year report to grade ourselves and to catch up. And one thing we noticed at the mid-year was that Q2 software companies were outperforming both in our private portfolio and in the public markets. And growth really bottomed out around, I want to say, May at about 10% forward 12 months growth rate. And it's back up to about 12, 13% now. Still, nobody's excited about 12 or 13%, but it's nice to see it bounce off the bottom. And why do I think it's that case? I mean, hopefully Jerome Powell will be lowering interest rates next week, and people see, a little bit of a loosening in the monetary, system and the economy. That will be hopefully good. Meanwhile, macro trends have largely held up. There's a little bit of challenge in the labor market, but consumers and businesses are still spending. So it's nice to see software hit the bottom. It's hard to imagine a software growth environment that stays at 10, 12, 13% for a long period of time, given the AI paradigm shift and all the other cloud paradigm shift that's still going on, right? Cloud is only about 25 or 30% workload penetrated to the overall B2B IT market, and Gartner predicts that'll be 50% by 2030. So there's a lot more to go in just basic blocking and tackling cloud workloads as well.
That's great. And just talking about your report for a second for the audience, we will, as we're putting the post out, we will add the link to the report. And Steve, how can folks sign up for an ongoing? Is there a list that they can subscribe to?
For sure, there's some way on our website to subscribe to that list, but anybody can email me and I'll make sure you get on the list, steve@sapphireventures.com.
Amazing. Just talking about the top 10 predictions you did this in January of 2025. And now if you kind of put yourself back in January, what out of those 10 predictions did you get right? And what's not playing out the way that you expected, and why?
Oh, okay. Well, maybe I'll start with the good news first, because my partners sometimes accuse me of looking at everything half full instead of half empty. Sometimes you do have to look at it half empty. But, the things I got right are the reacceleration of the IPO market. We said that there'd be about 10 software IPOs in 25, which is not quite a regular year, but it's pretty far back to regular year, which might be more like 15. And then we see 20 plus software IPOs in 26. Including hopefully some really, the big ones, like a Databricks or a Stripe or something like that, right? So I think we're on track with that, given what we've seen so far this year, and then we're definitely on track on the M&A exit environment as well. I predicted that M&A would be up over 20% this year, and we're seeing that both in deal volume and deal number of deals. Like Wiz, for example, at 32 billion is helping that number a lot, but there's been a lot of other good ones as well. We sold one of our portfolio companies, MoveWorks, to ServiceNow for 2.85 billion. So just example of the types of companies that are getting bought out there. But so M&A is also picking up, and limited partners in venture and the venture ecosystem will certainly do a lot better if we can continue to accelerate the return of money, because obviously if they need to invest more money in venture, they need the money back first, right? So that's the half full part. The half empty part, I guess, is that even though we've seen those signs of growth inflection that you mentioned, SaaS valuations still are in the toilet. I mean, the SaaS index that I track is trading at about 4.3 times next 12 months revenues, which, if you're familiar with SaaS history, probably something like 5 to 7 would be a more regular way average. I think the actual average is 5.9 or 6, but, it's sort of trends between 5 and 7. So we're at a pretty low point right now. I got that wrong. I thought multiples would re-rate, but I guess what we didn't anticipate was the real bifurcation between high growers and everybody else. So if you look at the public SaaS markets right now, you have the high growth companies that are growing at more than 20%, trading at a multiple about 11 to 12 times forward revenues. But you have the low growth companies, those trading under 15, growing under 15%. Those are growing, or those are trading at, I think, 3.8 times. I mean, under a 3 handle on a median SaaS multiple is just unheard of, right? So, really, I think M&A will take care of that. A lot of our private equity friends will take some of those companies private and help us get the median up. Also, growth in the underlying asset and lower interest rates will help as well. And then what else? There was one other thing that just growth. I mean, I said, I thought last year at like 13% was the bottom. It turns out this year, maybe like 12% is the bottom. I thought we'd be back at 14 or 15 this year, but we can always hope for next year.
I think that's a pretty great prediction, knowing what has happened in 2025 till date. Such an uncertain environment, and that's incredible. And again, it's all predicting and moving towards the right direction that we all want it to be. So very interesting mix of like signals, and I feel like we're at the transitional moment at this moment. So we kind of wait and watch. Just double clicking on the public SaaS growth projections, you mentioned has been revised down to like 10 to 12% range. How are the investors kind of like you all balancing kind of growth versus profitability as you're working with the companies?
Yeah, I mean, first of all, it's VC after all. So we focus almost entirely on growth. It's not that we're, irresponsible and not focused on profitability. I think that is a concept that you need as a public market investor or as a private equity investor. But our approach is to build a company from the 10 to 30 million of ARR that they are when we invest to 1 or 200 million of ARR. And if they have a big enough TAM, say a $2 billion plus TAM, they should be able to get to $100 or $200 million in revenues. That's only 5 to 10% of a $2 billion TAM if they have a good product solving a business need, creating new workflows, all of that sort of stuff. If they can do that, we would say invest against that, get your company to 150 million of ARR. At some point, if your growth slows to less than 15%, let's say, any software company can cut sales and marketing costs, can tighten the belt in R&D, can work on their cloud costs to get their gross margins higher, and can generally drop 25 or 30% to the EBITDA line and generate a lot of positive cash flow. But you're going to optimize profits under the curve if you grow the company first. So we focus on growing the company for at least 3 to 5 years before we ever talk about, profitability.
We're seeing kind of the AI native companies scale super rapidly, often reaching kind of like 100 million ARR in like a record time that it took like traditional SaaS companies a while to get to. Mm-hmm. And how do you compare their business fundamentals and kind of durability to the traditional models?
Well, I love this question because it gives me a chance to say what, I think we all believe here at Sapphire is that, AI is eating software, but I mean that in a very good way, right? Like that it's not really about SaaS versus AI. That's kind of a false dichotomy. If you think about the software markets over the last 30 years, they've been fueled by a series of 5 to 8 year paradigm shifts. We had the mainframes go to client server model and client server to internet to mobile, mobile to cloud, and now cloud to AI. And, these days we really don't talk about a company, are they a cloud software company or not? Like essentially most leading software companies are cloud software. And I think the same thing is true of AI. It'll be a distinction without a difference in a couple of years, where if you think about what makes a good software product, it's going to have a good user interface. It's going to have a functionality that's, at least, 10, 20, 30%, hopefully 2x or more better than the incumbent. It's going to help rewrite more efficient enterprise workflows. How are you going to do that in today's market? In a new company, you're going to tap into some of the resources available to you in AI. So it makes sense to me that essentially all new software companies are AI companies, in the sense that they're using AI first, and they're AI native companies. Older companies are finding ways to compete, as they must, to incorporate AI into their own products. And I just think it's really it's not a distinction that in a year or two we won't even call out the difference, but the same way nobody talks about on-prem versus cloud anymore, right? So yeah, that's the way I would think about it.
No, great point. Great. And closing thoughts, what advice do you give to SaaS founders navigating today's capital markets in such a shifting macro environment? What advice do you have for the founders to be successful?
Oh man, well, I don't know. I think I would just tell founders not to sweat the macro, right? Good companies are born in every part of the cycle, and actually, I think some of the best companies are born, in tougher parts of the cycle, because the bar is that much higher for funding great ideas. And so, I would just tell entrepreneurs, founders, to focus on building a great business that addresses key pain points for businesses. I would tell them to pick an aligned VC who knows their market, in the case of software, Sapphire. And I would tell them to hire and retain great people, and I'd tell them to have fun doing it. We can all take ourselves too seriously sometimes, but I would tell them to go for it, I guess.
Great advice. Super insightful. And I know this is time out of your super busy schedule, and really appreciate your time. And Steve, thanks again for joining us.
Thank you, Priya. It's been a pleasure. One of these days, I'm going to turn the tables on you and interview you.
Oh, anytime. And thank you all for joining us today, and looking forward to seeing you all soon. Thank you.